Being in alignment is critical to Thomas Manetta. In fact, that's the way he has structured his practice, to share values, cooperate, and communicate. Thomas explained his approach in the last episode, but this time around, I want to know how it helps with specific parts of his planning process. I'm Patrice Sikora. All right, Thomas, let's start with investment planning. How has your intentional alignment with clients changed the way you approach investment planning?
Well, I think the best way to answer that is to talk about the life experience that I've had with investing. And my father was a stockbroker, so I knew a lot about the markets, or at least I thought I did when I was a teenager. And then in my 20s and early 30s, I spent almost a decade on the options trading floor. So that really taught me about how professional traders viewed the markets and how they positioned themselves. And that left a mark on me. When I stepped into my first sales role outside the floor, I worked for an insurance company. And I sold very high fee mutual funds and annuities. And so I didn't like that experience with the insurance company that was pretending to be a financial planner. And I moved on to a couple wirehouses where I was a little less conflicted, but I was, I had something like this to share with clients, and it was called a quilt. And it showed the historical returns of asset classes and how no asset class was ever going to be at the top every single year. So the conversation was around diversification, which is important. It's very important even today. But you use that so you could position yourself to sell internal products that were probably not in the best interest of clients. And so that didn't really sit well with me. And then, because I couldn't make it work as a wirehouse broker, I have to own that. I took a job at Charles Schwab that, for me, I felt was a step down. I felt like, it wasn't, it didn't feel like a full service financial advisory role, and it wasn't. But the experience taught me how advice is offered at scale. And so I wasn't dealing with a handful of clients. I was dealing with hundreds of clients. And those clients were attracted to Schwab because, they were promised that it was going to be low cost, if not free. And so they were buying into this idea that they shouldn't, overpay or even pay for advice. And what I learned from that experience was that these clients were being offered oftentimes suboptimal solutions to their investment plan, and they were obviously paying a much lower fee, but they were getting exactly that. So it was cheap for a reason, and the idea was to get as many people into these basically suboptimal solutions, and then just move on. Because again, I wasn't a full service financial advisor; I was just a financial consultant, and they weren't my clients; they were Schwab's clients. And so I began to start to get very cynical about how these institutions offered advice. And that's what kind of molded this dissatisfaction within me, and kind of, really made me look at how, almost all of the institutions were basically offering it, but just in different ways. They were hurting people. They weren't helping people. They were hurting them, and they knew it. And that was accepted. But when I was at Schwab, I was fortunate enough to go to Berkeley and go through their CFP program, where I found people that were exploring all different levels of the financial planning process, which I was not exposed to at the time. I was just selling investment products. Mm-hmm. And so I evolved, the way that I looked at my role, what my job could be. I could help people without hurting them. I could help them through all these different stages of the planning process. I just needed to figure out a way to navigate into that role. And the experience at Berkeley led me to getting a master's at the University of San Francisco in financial analysis. And the end result of that was that I figured out after that experience, which was the core body of knowledge for the CFA program, that no one knows anything. No one really knows what's going to happen with the markets. They just, I mean, even the smartest people that were in that program, you get through it and you realize that it's very much textbook. It's very much, it's almost like it's taught like a science, but they really don't know, what the market is going to do. And, that was the feeling that I got when I left that program. And that kind of liberated me even more, because then it was just a question of getting clients into portfolios at the lowest possible cost possible in an investment plan that they really understood and that was, appropriate for them. And it was meant to help them and not hurt them. And the most important thing was to get them into an investment plan that would match their risk profile, such that if the market was really volatile, they didn't want to sell everything and get out. So you have to keep them invested, because the most important thing is compound interest. And if they can take advantage of that, then you've really won. And that's really the goal, or it should be the goal, just to keep clients invested and keep them away from this idea that, there are these products out there that are going to outperform the market. And yes, you're going to pay more in fees, but it's really worth it. And it's really not the case, because the market over time has historically delivered in the neighborhood of 8% on average for the past 50 years. And if you can make 8%, your money will double in less than 10 years. And so the trick is to just stay invested. And
compounding, what a wonderful idea. And are we ever taught about this in school?
No. Yeah, I think the quote is attributable to Einstein, who said it's the most powerful force in the universe. Yes. But it's true. And so when I finished that master's program, that was when I really wanted to go independent, and I did. And that started me on the journey of ultimately becoming an owner, where over the past year, I've been able to really deliver on that promise of having alignment with my clients. And the first step in that is the investment piece, which is usually where you meet them, because that's, typically a client will come to you with, and they'll show you their statements or their investment, or they have a 401k or something like that rolls over. But that's just the beginning. And if you get that right and they understand it and you start to build trust that way, I think that it follows through all the other stages of the planning process, where you're really, really delivering the value. Like, that's where you're really providing the most value. But if you don't establish that kind of trust with the investment piece first, I think that you're not being authentic, and clients will know that. They'll know that you're selling them something. They'll know it, and they won't open up like the experiences that I've shared in the earlier episodes with clients over the past year. And if you don't have that, then you're missing out on probably the best part of the whole thing. Right. And that is, really getting close to your clients and protecting them. So, yeah.
So what does a portfolio look like when a client typically comes to you?
Well, it can be really upside down, or it can be, or it can be hidden from them. I've seen clients that come to me with, products that have been sold, especially insurance products. I'm thinking about annuities that aren't appropriate for them. I'm thinking about mutual funds that don't really make sense in the aggregate. They're just kind of pieced together. There are clients that come to me that say, I'm not paying my advisor. I don't pay a fee to my advisor. I don't. And I look at their statements and I see that they have mutual funds, and inside those mutual funds, they're paying a lot more than 1% for those mutual funds, and that money's going somewhere. So they're paying, but they don't know that they are. It's nice to be able to do that at the outset, to help people correct that and let them see how there's a better way to invest.
They have typically an investment plan they don't understand. Do they want to understand it? When you try to explain to them, do they say, "Oh, that's not possible. It's not what I was told"?
Yeah, I think that it helps that I have so many years of experience in the business, and that I understand a lot of the arguments that other advisors have, that have preceded me, that have told them things, and I know how to unwind those arguments. But I think when you really show them how simple it can be and how transparent it can be and how they really can see where the money is going if they are paying any fees at all. And then I think in a way it empowers them because they feel like they have some sense of control now, whereas before they were just going somewhere because they thought it was free, or they thought they had a plan, but they really didn't have a plan, or the whole in its entirety, the plan just didn't really resonate with them. They just thought, well, I'm invested. That's all I have to do.
Yeah, that's for sure.
So
how do you think investing fits into the overall financial planning process?
I think it's where everything obviously begins, because you typically meet clients there, and then at the investment piece, and then you build from it, and you build to tax planning, and you'll build to estate planning and making sure that that's set up appropriately. And then you can do all the other things once they feel that they trust you. And then you build that trust such that now you're really helping them with cash flow management. You're helping them manage their overall financial picture, and they're allowing you into that. And when you do that, and when you're doing it from a place of alignment, which means that you're set up such that, and they know that, and that you are helping them without hurting them, really great things can happen. But it begins with the investment planning piece. So
do you think that new advisors today, young advisors today, are getting any of this in their classes? I know more and more schools have actually programs for financial planning, but do you think this is coming through?
I hope so. It seems like a lot more younger advisors are pursuing a CFP, and I've seen the numbers on how many young advisors are pursuing that instead of the CFA. The CFA was the high bar for the industry, and the CFP has become more valuable because, and I believe that it's because that's where advisors will be able to provide value going forward, because as the algorithms have taken over the market and investment planning will be more automated, if you will, it's not something that you're going to be able to charge a fee for. So just investment planning on its own won't be something that you can justify paying a fee for. But planning, if you're doing all the other stages of the planning process for a client, then I think that will be the place where you can build a business. And I think that a lot of young advisors are going that route, which is encouraging.
And with that all in mind, what do you think is the most important role you play when it comes to investment management and planning?
I think that the most important piece, which I touched on just a little bit earlier, was keeping clients invested, because people, the markets can get scary and people panic and they want to sell everything, and they always sell at the wrong time. It's always the case that they sell it. I mean, it just happened just, a month ago, and we went through all that tariff rigmarole. Yeah.
But I mean,
people were rightfully scared, and they were, and the conversations were with my clients, how serious do you think it is? Are we okay? Yes. Let's just stay the course. Great. And then, a month later, here we are. We're right back where we were 6 weeks ago. So without having somebody that you trust to talk to about these things, you will probably just follow your behavioral biases and sell at the wrong time and miss out again on that compound interest that we talked about.
Is it hard for you to stay, I won't say one step away, but not to get pulled into all the emotion?
I think when I was younger, I was much more prone to be seduced by that kind of the anxieties and the fears of the market. But as I've gotten older, you go through so many different, awful periods, like, the tech crash. I mean, I remember when my father went through 1987, which turned out to be nothing, but at the time it was really scary. And then I went through the tech crash on the options trading floor, and that was pretty scary. And then I saw firsthand what happened when I was dealing with a lot of clients at Schwab when in 2008 when Lehman failed, and I had all the structured notes from Lehman to deal with, and so it just kind of you just kind of get weathered by it, and you're just it's not like I'm immune from it. It's just I just don't listen to the noise anymore. And I mean, CNBC is a great example. I mean, you if you watch that show, if you watch that religiously, you would be terrified every day because that's what they want you to do. But you need to tune that out, and you need to really focus on the things that you can make the most positive impact on your clients' lives, which is not always investment related. I mean, you can help them, reorient their portfolio, but you're really going to deliver a lot of alpha, if you want to call it that, with things like tax planning and estate planning and cash flow management. Those can be really valuable to a client.
You bring up a good point. Where do you go for information on a daily basis? Do you go to the written word? Do you go to the digital word? Do you go to the televised word or the audio word, radio?
Yeah.
Where do you go and how do you balance it off? I mean, I'm an information junkie. I admit it right now. Okay.
Yeah.
I listen to everything. I read to everything I can. But some people are so fixated on one source.
Mm-hmm.
They've got to understand there are other sources.
That's the problem, isn't it?
Yeah.
If you get caught in the wrong, echo chamber, then you're obviously going to be, you're going to have blinders on. I was a really big, I really got a lot of information from Twitter back when Twitter was, before what it has become. And it wasn't as toxic as it became. And there were a lot of smart people on there, and I learned so much from them. And back maybe, I don't know, 8 years ago, 8 years ago, and then it obviously changed. But I get a lot of information from podcasts. I get a lot of value from listening to podcasts from really smart people that challenge me. I like to be challenged. I like to think about things differently. I like to to realize that maybe I didn't see the whole picture. And so I'll give you a great example. In 2019, I was listening to 3 different podcasts, and they were all talking about this virus that was, there was this whisper about this virus, and I didn't know anything about it, obviously. And I found it intriguing. And then and then it started to get more and more pronounced. And so I was talking to my clients about that before it ever came in. And I had a client who had a really big position in Apple, huge position, and I was able to say, I think this is going to be a little bit worse than people think. And she was like, well, I want to sell some of my stock. And I said, we can't do that. But we can sell some covered calls against it and then kind of weather the storm. And so we did that, and she didn't sell the stock, and she made a little bit of money, not a lot, but she did a little bit. And so those podcasts are invaluable to me because they are, people that maybe aren't in the financial industry. They're talking about other things that are related to it. Like there's a podcast that I'm listening to now that's talking about how nuclear power might be the solution for these big data centers for, AI, that they're building these massive data centers, and they need power. They need, they need power that's not intermittent like solar or wind. They need something like nuclear.
And we can't meet the demand as it's growing.
Right. And of course, there's that mountain to climb with people who still remember 3 Mile Island like I do. And
I do too.
Yep. And so
I lived east of 3 Mile Island. We all sat here going, Oh my goodness gracious.
Right? Yeah. We used to drive by it every year. And so like you said, there is this demand for it. And so I think it's going to be something that becomes more and more prevalent. And that's not something that you would ever would have thought maybe 5 years ago, but it's changing. And that's that narrative is changing. And I think that will have knock-on effects in every other part of the market, because if we're adopting nuclear power in this country at scale, that would be incredible. But it's going to take some time, I think. So
Right.
Yeah.
Well, Thomas, is there something we haven't touched on here that you would like to make sure we do?
I think that, I think that's the big part of the discussion that I wanted to have today about how investment planning is. It's obviously very important, but it's the foundation for so many other things that follow that are equally, or if not more important to your whole financial planning picture. So,
all right, fantastic. And how can people reach you?
You can reach me. My website is www.manettawealth.com. You can email me at thomas@manettawealth.com. And if you'd like to give me a call, it's 415-640-2121.
And you might even share the podcast you're listening to?
Please do.
All right. All right, folks, be sure to follow this podcast to know the next episode is ready for you. That way you don't miss out on anything. And of course, share with others. I'm Patrice Sikora, and thanks for being with us.
Thank you for listening to Behind the Curtain Finance. Click the follow button to be notified when new episodes become available. Visit our website at www.manettawealth.com or give us a call at 415-640-2121. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Manetta Wealth. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Copyright 2025. This content, which contains security-related opinions and/or information, is provided for informational purposes only and should not be relied upon in any manner as professional advice or as an endorsement of any practices, products, or services. There can be no guarantees or assurances that the views expressed here will be applicable for any particular facts or circumstances and should not be relied upon in any manner. You should consult your own advisors as to legal, business, tax, and other related matters concerning any investment. The commentary in this post, including any related blog, podcasts, videos, and social media, reflects the personal opinions, viewpoints, and analyses of the Manetta Wealth Management employees providing such comments and should not be regarded as the views of Manetta Wealth Management LLC or its respective affiliates, or as a description of advisory services provided by Manetta Wealth Management or performance returns of any Manetta Wealth Management investments client. References to any securities or digital assets or performance data are for illustrative purposes only and do not constitute an investment recommendation or offer to provide investment advisory services. Charts and graphs provided within are for informational purposes solely and should not be relied upon when making any investment decision. Past performance is not indicative of future results. The content speaks only as of the date indicated. Any projections, estimates, forecasts, targets, prospects, and/or opinions expressed in these materials are subject to change without notice and may differ or be contrary to opinions expressed by others.